the show is Dobar dan. That means good day. This is TalkCast PDX. You can find us on the web, talkcastpdx.com. Name of the show is The Bogdanich Perspective. I'm your host, Paul Bogdanich, and welcome. It's June 15th, 2021. Title of today's show is Runaway, as in either we have a runaway market or we may want to consider running away. We made 4 portfolios to demonstrate how the market works, and one of them was discretionary, and last week I sold some of the losers out of the discretionary portfolio, and in between that and revenue from calls and dividends, we had $13,230 in the portfolio last week, and I said I was going to look around and find some stocks to purchase or look for stocks to purchase as of last Friday and report that today. And I did that. I went looking for stocks, and I pulled the top 300 stocks out of the S&P 500. In our 4 portfolios, you'll remember we had one that was a proxy for the largest stocks in the S&P 500. The top 30 stocks represent over 50% of the S&P 500. When you pull the top 300 stocks, that's 95.4% of all the value in the S&P 500. So I pulled the top 300 and looking at basically the entire S&P 500, ran some statistics on them. Basic statistics, and here's what I found. You have 11 sectors in the S&P, and the basic count for these things, internet technology has 50 stocks out of the top 300. That's the most. Industrials, 44. Financial, 42. Healthcare, 41. Consumer discretionary, 30. Consumer staples, 23. Materials and real estate, 15 each. Energy and utilities, 14 each. And communication services, only 12 in the top 300. If you look at that as a percent of capitalization, IT again is the largest, 25.7%, which is a lot, over a quarter, more than double the next category, which is healthcare and communication services. Communication services only had 12 stocks out of the top 300, but they represent 11.8% of the capitalization of the top 300. Healthcare is also 11.8. Consumer discretionary and finance are also 11.5, 11.7. Industrials is 7.7, consumer staples is 6.5, and then energy, materials, real estate, and utilities are all down around 2%, with utilities being the lowest at 1.9 and energy being the highest at 2.6. Looking at them, what I was doing is I was looking for stocks to purchase, and I was looking for stocks that had some upside without hitting a new high, without hitting a new all-time high or 52-week high. Some stocks that were maybe down on some temporary news, like the losers I sold last week, or something else that had some upside to it without bumping into its all-time maximum value. And so I ran some statistics just on the top 300. And one of them I ran, you take the current trading price of the stock. So let's say the stock is trading for $80, and let's say that it's 52-week high. 52 weeks is roughly a year, so its high closing price over the last year was $100. So it's currently trading for 80. Its 52-week high is 100. So you take 80 and you divide that by 100 and you get 80%. In other words, the stock is currently trading at 80% of its maximum value over the last year. And it's important to note there's 2 sectors, energy in particular, because that trades more or less off the price of oil. And real estate has been in a funk. But apart from energy and real estate, pretty much every other sector, the 52-week high is the all-time high. Just because the markets have been advancing so much, so it's very difficult to find a stock that had a higher price 2 years ago or longer than that than it does now, other than energy and real estate. So apart from energy and real estate, pretty much a 52-week high is an all-time high. And I ran that statistic, trading price divided by the 52-week high. And this is the average per sector of these 300 stocks. Real estate, 97.5%, okay? So, and that's the average, okay? That means that these stocks are trading, they've never been higher. A couple of them here and there might have been 5% higher, but the average for the 15 stocks in that sector is 97.5%. And the difficulty with that is it doesn't get any better. Finance, 97.4%. Energy, 97.3%. Consumer staples, 95.6%. Industrials, 95.35%. Materials, 94.1%. Utilities, 92%. Communication services, 92%. Internet technology, 92%. Consumer discretionary, 91%. And the lowest on the list, healthcare, 91%. So every stock, virtually, out of these top 300s is trading at or near its 52-week high, which in most cases is its all-time high. And then another thing I looked at is how much are the stocks up year to date. And this is, again, an average per sector for the 300 stocks, which is 94.5% of the value of the 95.4% of the value of the entire S&P. Energy is up 50% year to date. Finance up 30% year to date. Real estate up 22.5% year to date. Materials up 20% year to date. Industrials up 17% year to date. Consumer discretionary up 15% year to date. Consumer staples and healthcare both up 11% year to date. Internet technology up 10% year to date. Communication services up 7% year to date. And utilities up 4.3% year to date. The combined lesson, if you will, from those statistics is that if you purchase virtually any stock in any of these sectors, with the exception of real estate and energy, but those are up 50% year to date and 22.5% year to date. But if you purchase any stock, the only way it's going up is if it hits a new all-time high. Or a 52-week high, certainly, in any case. That's the only way it's going up because they're trading, 97%, 95%, 96% of their all-time highs. So the only way that you're going to buy a stock now and it's going to go up is if it keeps making new all-time highs. And that's it's true for virtually every stock in the top 300 stocks, which is 94.5%. So that means the only way that you can collect a basket of stocks and have a reasonable probability that they go up is if the market as a whole, as measured by the S&P, continues to hit new all-time highs every day, every week, every month. And it's been doing that. Last Friday, what it closed at? Last Friday, the S&P closed at 4,247 points, new all-time high. Yesterday, I don't remember what it closed at, but 2,250 some points, new all-time high. Very interesting trading yesterday. It was down all day. The S&P 500 is an index. It was down all day. Last hour of trading, it soars, and it manages to close up a few points. And if you've been trading a long time, what that means is there's a extremely large buyer somewhere, and he calls the traders in the morning, and he says, buy me this, that, and the other thing. And the traders try and accumulate his order from much smaller purchases all during the day, and then they transfer it to him at the end of the day, him or her, it, whatever it is, got to be an institutional concern. But they transfer it to the buyer at the end of the day, and they goose the price. But that's the only way you see price action like that. And it's State Wealth Fund, Central Bank, BlackRock, Citadel, Renaissance, somebody, very, very large purchaser, is what made the market run to an all-time high yesterday. So I looked again and just, how expensive are these stocks? Maybe these stocks are making a ton of money and they're not that expensive. So I went and looked at the P/E's. P/E is price-earnings ratio. You take the trading price of a stock and you divide it by the earnings per share for an entire year. That comes in two flavors. You can use the earnings for the year just passed, or you can use the analyst expectations for the year going forward. One's called trailing 12-month P/E, and the other is called forward 12-month P/E. And by sector, if you look at the P/Es, real estate's 60 to 1, internet technology and healthcare are both 44 to 1, consumer discretionary is 37 to 1, consumer staples 32 to 1, materials 32 to 1, utilities and communication services 30 to 1, industrials 30 to 1, and so on. The average for every stock in these top 300 stocks that again represent 94.5% of the index is 35 to 1. That number historically that number is 21, 22, somewhere in that nature. The forward 12-month P/E, if you believe that the analysts never make a mistake and they're not underestimating earnings and everybody's going to hit their earnings, the forward P/E average for all these sectors is 25 to 1, which is still pricey. So that means that these huge numbers that we're seeing are just it's like a home that 1 month is trading for $100,000 and then the next month is trading for $120,000. Still the same home. Didn't put a new kitchen in it. The lawn's still the same. The roof's still the same. Everything's still the same. It's just that now it's worth $100,000. It's inflation basically, or asset inflation. So the question immediately becomes, what's causing it, and can it be sustained? Is the market going to make new all-time highs every day, every week, every month from now until the end of the year? As to what's causing it, that's pretty simple. It's been 16 months in round numbers since the pandemic started. And if you look at the 16 months since the pandemic started, call it mid-February of 2020, the Fed balance sheet, in other words, the total of assets that they bought, including stock market assets, bonds, everything else, has gone from $4.2 trillion, which is a lot, to $8 trillion. So that's almost a double. So you have $4 trillion of added money there. The government, federal government, over the same time period has spent $9 trillion, of which maybe $4 trillion they got in taxes. So that's another $5 trillion. The deficit spending rate is 15% of GDP for 2 years in a row, bringing the total debt to GDP ratio probably close to 150%. I haven't checked the exact number, but it's above 140. So they've added $9 trillion. $9 trillion. A trillion is 1,000 billion. A billion is 1,000 million. So that's $9,000 million. It's a lot of money, and it's just inflating the prices of all this. So, are they going to continue with that through the end of the year to make the market go new highs every day, every week, every month? And to get an estimate of that, you have to look at the broader trends. So I plotted the S&P again. Remember, this all started back in October 2011 with Ben Bernanke, quantitative easing in response to the financial crisis. The roots of all this are in the financial crisis. But anyway, if you plot a curve and try and match where we are now back to then, and you use a compounded curve, it falls almost exactly on 13%. So if you use a compounded curve of 13% compounded from December 30th, 2011, all the way to June 11th, which is last Friday, it falls right on 13%. If you extend that 13% back from December 30th, 2011 out to the end of the year, you come up with a number of 4610. So that implies an S&P closing value for the end of the year, 4,610. We're currently at 4,240 or 4,250, somewhere in there. If you don't want to run it that far back and you just take it from a pre-pandemic number, pandemic started to affect the market in February, so let's go with December 31st, 2019, the end of the year, right? And if you take that and plot a curve, that curve is on a 19% annual return. It's almost 20%. It's like the interest rates under Paul Volcker in 1980. I mean, 20%. It's huge. That number extended out to the year is 4,750. If you look at this, the market hit a pre-pandemic high on February 19th of 2020. And it was clipping along pretty good at that point. It was above the Fed target and everything else. But February 19th, 2020, hit a high of 3,386. Then the pandemic started. Within 1 month, from February 19th to March 23rd, it dropped from 3,386 to 2,237, which is a drop of 33.9%, so 34%, or about a third. The Fed reflated it, of course, because that's even below the 9% floor significantly. But they added a pandemic premium, as we've discussed, and they openly discuss to help the economy recover from the pandemic premium. And they've never said what it is, and everybody's trying to quantify it. But if you go from that low on March 23rd of 2,237 points, in the year immediately after that, from March 23rd, 2020 to March 23rd, 2021, the value of the S&P soared 75%. If you go from that low to last Friday, which was June 11th, the market soared 90%, 89.8%. Year to date, just from January 1st, 2021 to today, we're up 13%. And to extend these numbers out to the end of the year and have any confidence at all that these stocks are going to go up, you're looking at about 26.5 or 27%. And that is a bit much for me. If you look at another measure and you take all the stocks in the S&P 500 and you take their market capitalization, the price of the stock times the number of the shares of stock that they have in the calculation, which goes by the float, but that's another matter. And you add all those up, and then you compare that as a percent of GDP. Currently, we're at 275% of GDP. In other words, the total trading value of the market is almost 3 times what the GDP of the country is in a year. That's another all-time record. Typically, that number is down below 200%, but now it's 275%. It's soared. It's been going up every year since the financial crisis, since we started printing money. I would point out prior to that, it used to be down around 100% of GDP, but now it's 275, almost 300% of GDP. So it's very expensive. But could they do it? They could. It's not unprecedented. If they take the long view and they go from December 30th, 2011 and say, the average return over the period has been, 13%. We want to maintain the 13% through the end of the year, and then we'll talk about easing the pandemic premium out of it. There's historical precedent to do that. If you look at the S&P 500 by year, for the year 2012, January 1st, 2012 to December 31st, 2012, it was up 13.35%. 2013, it rose 36.6%. 2014, it rose 5.6%. 2015, it fell 2.2%. 2016, it was up 12.2%. 2017, it was up 18.4%. 2017, it was up 18.4%. 2018, it was down 6.3%. And this is where we really start to run the numbers, 2019, 20, and 21. 2019, it was up 29%. 2020, it was up 16.3%. And so far, for half a year in 2021, it's up 13.1%. And if you average all that out, the average is 13.6%. So if you apply a 13.6% curve all the way back to December 30th, 2011, the stock market is right on that curve and implies a year-end closing value of above 4,600 points. So they could do it. The politics of it favor them doing it, in my opinion. The Fed has a number of governors, and each gets appointed for an 8-year term, I think. But then they pick a chairman, and the chairman rotates every 4 years, and the chairman is currently Powell. but his chairmanship, not his seat on the Fed Open Market Committee, but his chairmanship runs out this year. The decision whether to renominate him or replace him is in the hands of the president. The Secretary Treasury, or the Treasury of the Secretary under this administration at least, has tremendous input into that decision. The Treasury Secretary is Janet Yellen, former Fed chair herself. Very old woman. Not into new ideas, just very old. Very set in her ways, kind of like everybody up there right now. And she's in favor of this continued money printing. I think it's causing too many problems. Price of housing is going up 12% a year. You can't find a place to live. They're trying to, in my estimation, they're trying to use broader inflation to talk the market down and that kind of thing. There was a guy, Paul Tudor Jones. He runs a firm called Tudor Investments. He's one of the better ones. He doesn't talk all the time, but he talks some of the time. Big wealth fund. And he was on one of these shows the other day. And they always talk their book. What they do is they make a determination where the markets are going. Then they do their investments. Then they come on TV and try and get you to do their investments to make sure that their investments go up. So he's talking his book, but as they all do. But when they started the interview, the person that was interviewing said, "You, Mr. Jones, what do you think of this market?" And the exact language that the guy used was "batshit crazy." Is what he said, and I kind of concur. And so I was looking for a stock that had a reasonable probability of increasing without setting a new all-time high. Pulled the top 300, couldn't find any. That didn't have some kind of a business problem that explained why it was down off its all-time high or 52-week high. Maybe Amgen in the biotechnology sector could go up 5% without bumping into an all-time high. A couple of energy, just almost nothing. And I looked at that and thought about it. And like I said, I thought I was going to buy 3 stocks with the extra money that I had. I didn't do that. Bought put options on my big gainers instead. If you'll recall, a put option is where you pay some money and you lock in the ability to sell shares at a certain price. So if I buy a put at $100 and the stock price falls from 80 to 100 on the expiration date, I can put it to you for $100. I can force you to buy the shares for $100. And so I bought puts on my positions instead of buying new stocks. Kinder Morgan, we bought it at $16.50. It's $19.25. We bought the $20 puts, July 16th, $20 puts. Target, we bought it at $205. It's $233. We bought the $230 July 16 puts. SPGI, which is S&P Global data firm, we bought it at $269, trading at $393. We bought the $390 July 16 puts. Comcast, we bought it at $53.50. It's $57 currently. We bought the July 16th $60 puts. APD, which is Air Products and Chemicals, bought it at $300. We bought it at $284. It's trading at $300. We bought the $290. We had to go August 20 on these, so we bought the August 20 $290 puts. And Costco, we bought it at $360. It's trading $381, $382. And we bought the $380 puts, July 16th puts on those. To buy all those puts on all those stocks in small numbers, what do we have? 250 shares, 270 shares, 280 shares, 360, 380, 400 shares is all. But these stock values are $200-300 a share. But we bought puts on 400 shares. Cost us $850. The worst that happens to us is the share prices of all these stocks stay right where they are. Don't go up, don't go down, in between now and the expiration date, which is generally speaking July 16th. If they do that, then we don't make any money because they went up. They didn't fall, so our puts aren't worth anything. And the puts expire. We lose our 850, and that's the worst that can happen to us. If stocks fall, hopefully they fall hard and we make good money there. If they go up, we spend $850 of the gain. And that's what I did. Didn't see any new stocks that I immediately fell in love with. I'll keep looking. Might find one or two, but I was just, unless the market makes a new high every day, every week, every month, these aren't going up. They can't. It's mathematically impossible. If the constituent stocks go up from these levels, the S&P 500 has to make new all-time highs every day, every week, every month. I don't believe it. So I behaved accordingly. Anyway, we have 4 portfolios. Look at them really quickly. 3 of them were proxies for the S&P. The top 30 cap weight is just the top 30 stocks, which is more than 50% of the value of the S&P 500 cap weighted. So it favors the huge companies, the behemoths, Amazon and Microsoft, Apple, Apple, Microsoft, Amazon, stocks like that. And then we did top 30 equal weight, same 30 stocks, but we didn't favor investment into these behemoth stocks. We equal weighted everything. When you do that, you get concentration in the communication services and internet technology sectors. So we created a third portfolio, 11 sectors in the S&P, 3 stocks per sector. That's called top 3 per sector. So we just picked 33 stocks. And then my discretionary portfolio, which I call the large liquid leaders, which I've sold stocks in. Good thing, too. They went down again, but we didn't own them, so we don't care. And doing all these puts and calls. And last week, the S&P 500, as I said, hit a new all-time high, 4,247.44 points. If you had $100,000 in your portfolio, which our hypothetical portfolios did, you would have expected to get back $415 last week. And the top 30 cap weight, which is the proxy for just the largest stocks in the S&P, gained 1,025. So more than double the S&P. And as you'd expect, the list of stocks that drove it up that high were Amazon, Microsoft, Google, Apple, Tesla, and Visa. So all big cap stocks, and particularly Amazon, Microsoft, Google, and Apple, those are the 4 largest. That's numbers 1, 2, 3, 4, not in that order, but Apple's the largest, Microsoft second, I think Amazon's third, and Google is like 5th, I think, or something. But hey, the largest stocks, so that's what pulled the market up last week, just those 4 stocks. That's why it hit its all-time high that it did. That portfolio only had one loser, J.P. Morgan, and that's because J.P. Morgan let it be known that their revenue for the quarter ended June 30th is probably not going to be as high as some people are expecting. Jamie Dimon said that. He's the CEO. Anyway, go to the top 30 equal weights. Remember, same stocks, but it's not capitalization weighted, so it doesn't favor these behemoths. And this one only went up $417, but the market was supposed to return you $415, so this was spot on. Names are different. You had 2 stocks that went down, Bank of America, J.P. Morgan, for reasons I've already discussed. The stocks that went up, because you didn't favor investment in these huge cap stocks, Adobe gained actually 7.3% on the stock price last week. It added $250 to the portfolio. And in this one, Amazon, PayPal, and Microsoft, again, were the other stocks that pushed it up. So basically, high cap IT stocks is what was responsible for the market gain last week. Top 3 every sector. Remember, the market should have returned $415. This one lost $301. We created these portfolios 8 weeks ago, 9 weeks ago, maybe even 10, I don't remember, but 9 or 10 weeks. First time I've ever seen this one underperform the S&P that badly. Usually it outperforms. But it lost $300 and the market gained $415. Only had one material winner in it, Amazon, $141, and then Microsoft added 83, Visa added 67, and then you get into Prologis, a real estate concern, NextEra Energy, a utility, Tesla, but I mean, it didn't make any money, it lost. Big losers in this one, J.P. Morgan, Bank of America, Lynn Corporation backed off a little bit, And United Parcel Service lost at $126, but UPS has been up huge on great earnings the last 2 weeks, so it's just giving back a little. Nothing to see there. And then the large liquid leaders, the ones that I sold the dog stocks and used to have 24 stocks in it. Now it only has 21. 13 went up, 8 went down. It returned $281. So it underperformed the S&P, but did not lose money. The only had 2 losers, Lynn Corporation, which I already have the calls on, and JP Morgan, which I'm naked on, but no puts or calls, naked. Those were the 2 losers. Had 1, 2, 3, 4 gainers. Thermo Fisher Scientific, which we discussed last week. I wanted to hold it. Thought it would claw its way back. I think it's going to do it. Microsoft was up pretty good last week, almost 3%. So that added Pfizer, $40, which is where we have it boxed. If it goes up or down from 40, we make a little dough either way. And then Kinder Morgan, KMI, was up 87 for the week. And that about does it for me. We'll see. I didn't buy any new stocks. I don't have tremendous confidence that the market's going to make new all-time highs every day, every week, every month. So I'm either going to be a hero or a goat, right? Email me with questions, comments, or suggestions. The email to do that is paul@stockbetor.com. Paul@stockbetor, and better is BETTOR.com. This has been the Bogdanich Perspective on TalkCast PDX on the web at TalkCast PDX. Thank you for listening, and do Virginia. That means goodbye.